Hey, faithfully delivering value and breaking down the world's best books. Hello, this is Sally's Book Talk. Today, I'll interpret a book called Laughing at the Stock Market. The author is William O'Neill, who is one of Wall Street's most successful senior investors. He was born in 1933, started stock trading at age 21, and officially entered the industry as a stockbroker at 23. By age 30, he founded a stock brokerage firm named after him. O'Neill experienced stock market crashes triggered by the Watergate scandal and oil embargo, as well as the tech stock frenzy at the end of the last century. After weathering the ups and downs of bull markets, he still managed to laugh at the stock market. Not only is he a trading master with over 50 years of hands-on experience, but also an entrepreneur. In 1984, he founded Investors Business Daily, which grew rapidly and became a major competitor to the Wall Street Journal. Besides running a newspaper, O'Neill is also a best-selling author. The edition of Laughing at the Stock Market we're looking at now is already the fourth edition. The first edition of this book was published in 1988 and sold over 2 million copies nationwide in the U.S. Over 30 years, countless ordinary readers have achieved significant gains under O'Neill's guidance, even changing their entire lives. Among them are newlywed couples who started trading with $7,000 from wedding gifts and $5,000 in savings, reaching seven-figure net worth in just a few years. Also, a retired restaurant owner invested $400,000 and earned $700,000. Even more astonishing is a real estate agent who achieved a 130% profit from stock trading during the 2008 market crash. What benefited these readers most is O'Neill's famous CAN-SLIM system, which is the essence of his investment method and the core content of this book. O'Neill is a research-focused trading master. He selected the top 100 performing stocks from millions in the U.S. market. By studying how these high-performing stocks behaved before their big rises, he summarized 7 rules, and the English initials of these 7 rules spell CANSLIM. The American Association of Individual Investors compared O'Neill's CANSLIM system with the methods of Peter Lynch and Warren Buffett. Later in 2001, they published an independent research report stating that by adopting the CAN-SLIM system, investors can achieve the best and most consistently stable performance annually. In 1991, O'Neill's 24-year-old partner, Freestone, participated in the National Investment Championship. But by applying the CAN-SLIM system, he achieved a 279% return and became the runner-up that year. This championship wasn't just theoretical paper trading. It involved real money, battling it out in the market. In 1992, he again achieved a 120% return and became the runner-up once more. Regardless of whether the market is bullish or bearish, investors who strictly follow the CAN-SLIM system can succeed in real-world trading. Now, let's go through each of the 7 rules represented by the 7 letters one by one. First, we'll talk about the letter C, which stands for current quarterly earnings per share and sales per share. When selecting stocks, you must look for those with significant growth in current quarterly earnings. The higher the earnings, the better. Through his study of the top 600 performing stocks from 1992 to 2001, O'Neill found that before these stocks surged, over 70% had impressive performances in their latest quarterly reports, with earnings increasing by an average of 70% compared to previous quarters. For example, Cisco Systems saw earnings growth of around 150% in the 2 quarters before October 1990, and its stock price subsequently rose steadily, increasing 15-fold over 3 years. Dell Systems announced that in the 2 quarters prior to November 1996, its earnings per share increased by 70% and 100% respectively. Over the next 27 months, Dell's stock price rose 18-fold. Of course, such stocks aren't common. Only about 2% of stocks in the US market can meet this standard. Like, but O'Neill believes that what you should look for are these star stocks with outstanding operational performance, not just average ones. Additionally, to avoid companies whose performance is heavily affected by seasonality, you can use the year-over-year growth metric. That is, compared this quarter's earnings per share with the same quarter's earnings per share from the previous year. This way, you can get an objective assessment of the company's operational situation. However, it's crucial to ignore those one-time, non-recurring earnings. For example, a computer company's last quarter earnings included a large portion from selling a property, which is a one-time gain. But that actually doesn't represent the company's true sustainable profitability. So such earnings should be excluded from reports, since they're usually one-time gains. Whether you're a stock market newbie or seasoned investor, it's best to set thresholds when selecting stocks. O'Neill suggests that if a stock's year-over-year EPS growth is less than 18%, don't touch it at all. Many successful investors set even higher thresholds, requiring 25% to 30% quarterly growth as minimum standards. To be safe, only consider stocks showing substantial growth over the past 2 quarters. Sales figures in quarterly or annual reports should also be examined. And ideally, pick stocks where sales grow in sync with earnings. They have greater upside potential, because maintaining steady EPS growth requires corresponding sales growth. Otherwise, EPS growth becomes unsustainable. But also, if a company consistently grew around 50%, but suddenly reports just 5% growth, its outlook may be deteriorating. Oh, sure, even top companies occasionally underperform, but check if earnings significantly dropped for 2 consecutive quarters. If so, avoid such companies. Okay, after C, let's discuss the second letter, A, which stands for annual earnings growth. The minimum requirement here is at least 25% annual earnings growth. For exceptional companies, you might consider stocks with even 100% annual growth rates. Following the principle of selecting the best, you'd naturally choose such stocks. Truly investment-worthy stocks should maintain steady growth over the past 3 years. For newly listed stocks without 3-year records, ensure substantial earnings growth over 5 to 6 quarters with impressive revenue performance. This stock selection standard can quickly eliminate about 80% of listed companies in any industry. So let's see who made the cut. Xerox had 32% annual earnings growth in 1962. Then from March 1963 to June 1966, its stock price increased 7-fold. Between 1977 and 1990, Walmart's stock soared 112 times while maintaining 43% annual earnings growth. Combining the first 2 selection rules could help you pick a superstar stock. When discussing earnings per share, we must mention the PE ratio, the ratio of a stock's price to its earnings per share. For years, many analysts have used PE ratio as a key metric for stock selection. A low price to earnings suggests the stock is undervalued and should be bought. Conversely, a high price to earnings means it should be sold. But O'Neill's study of the top 100 stocks from 1880 to 2008 found that, contrary to popular belief, PE ratios don't correlate with price movements. So don't avoid great stocks just because of high PE. Generally, the average PE is around 15 times. Top-performing stocks can have price to earnings of 25 to 50 times, like Google in 2004 with 50 to 60 times price to earnings, whose stock later tripled in value. Okay, next is the third letter N, representing new products, new management, and new price highs. O'Neill found over 50% of stocks with amazing earnings growth met at least one of these new criteria among top performers from 1880 to 208. And for example, Houston oil and gas surged nearly 10 times during 1972 to 1973 after discovering new oil fields, then tripled again in 1976. As Microsoft's products dominated the PC market, its stock rose nearly 18 times from March 1993 to December 1999. Companies launching remarkable new products gain fresh momentum that drives stock surges. Here's a small example from A shares. Tai Gang Bu Shu stock successfully developed ballpoint pen tipped steel in January 2017, filling a domestic gap for years, and its stock price rose 27% in 3 days. But regarding stocks hitting new highs, O'Neill conducted a survey during his investment lectures. 59% of individual investors said they wouldn't buy stocks at new highs. Moreover, this tendency isn't limited to individual investors. Most institutional investors also have this habit. If you don't change your mindset in time, you might miss out on great stocks. Many stocks that seem already expensive can still climb higher. So for stocks reaching new highs, how should you time your entry? In the practical tips below, we'll explain the fourth letter S in CANSLIM, which stands for supply and demand of stocks. This rule simply means rarity increases value. If you have two stocks to choose from, one has an issuance of 5 billion shares, the other has 50 million shares, then with other factors equal, the stock with fewer shares often performs better. That's why many people favor small cap stocks. Additionally, pay attention to companies that buy back shares in the open market. Moreover, this action reduces shares in the market, thereby increasing earnings per share. For example, IGT International Game Technology announced a 20% share buyback in 1989 and 1990. By September 1993, its stock price had surged over 20-fold. The fifth letter L in CANSLIM refers to selecting leading stocks. Generalizing, selective is the top three in strong industries become leading stocks with huge potential, while others perform averagely. For example, the retail leader Jarden Corporation saw its stock rise tenfold from 1988 to 1992, while others in the same industry underperformed. However, note that leading stocks aren't always the most famous old companies. Focus on emerging forces with explosive performance. Additionally, in a bear market's end, when the overall market rebounds from lows, the first stocks to hit new highs are the leading ones you seek. The sixth letter I in CANSLIM refers to institutional sponsorship. How much of the stock is held by institutional investors? A successful stock doesn't need massive institutional attention, but should have at least several institutions invested. Also, it's equally important to track whether the total institutional holders are increasing or decreasing. If a stock shows steady earnings and volume growth over recent quarters, while institutional numbers rise, it's a solid buy. But beware the risk of over-ownership by institutions. This term was coined by O'Neill in 1969 to describe stocks with excessive institutional holdings. When bear markets hit, over-ownership triggers massive sell-offs, like a stampede. In summer 2000, Cisco stock was held by over 1,000 institutions. When its price crashed, institutional selling created an unstoppable downward spiral. The final letter M stands for market direction judgment. O'Neill insists individual investors should never ask others, "How's the market doing?" Most Wall Street analysts missed the 2000 peak. Learn to analyze cycles yourself and always follow the trend. While some investors favor fundamentals and others technicals, O'Neill masters both, blending them in his timing and selection strategies. He advises personally analyzing daily index or volume changes and leading stocks movements to gauge market trends. All 7 CAN SLIM rules are now covered. In practice, you must effectively combine them because most winning stocks meet all 7 criteria during their breakout phases. If you find a stock with all 7 traits, congratulations, it could become your cash cow. After decades in U.S. markets, O'Neill witnessed countless investors losing money or stagnating. O'Neill believes individual investors wanting to excel in the market must first analyze their own weaknesses. Sometimes, whether you're a novice or experienced investor doesn't matter at all. In fact, bad habits formed by seasoned investors can have even more severe consequences. What investment habits are considered bad? In this book, O'Neill identifies 21 such habits. Next, we'll focus on analyzing the 5 most common ones. First is not cutting losses early, holding until losses become severe, a costly mistake nearly all investors make, clutching at hope that the stock will rebound, that often waiting worsens the situation and deepens losses. In his U.S. seminars, O'Neill advises cutting losses immediately when a stock falls 7 to 8% below your purchase price. Don't linger. Second is buying during downtrends, sinking deeper into losses. Buying falling stocks seems like bargains, but often traps you. In 1999, O'Neill met a woman who bought Xerox at $34 during new lows, thinking it cheap. But a year later, Xerox plunged to $6. Third is not learning candlestick charts, missing trading opportunities. Individual investors should learn chart reading and identify reliable breakout patterns. Trading by gut without chart skills means missing big winners. Fourth is preferring penny stocks. Many can't resist $2, $5, or $10 stocks, but cheap isn't good, good isn't cheap. This saying applies perfectly to stocks. Always buy the best, not the cheapest. The best stocks aren't necessarily the priciest, but certainly aren't cheap. Most institutions avoid $5 to $10 stocks, let alone those under $5. So, fifth, buying stocks based on rumors. In O'Neill's view, many so-called insider tips circulating in the market are just rumors, often stemming from casual remarks with no factual basis. Even opinions from so-called experts on TV are debatable. Before buying stocks, you must do your homework and truly understand the company. That's the first step to profiting in the market. All right, we've covered the CAN SLIM system and common bad habits among investors. Next, we move to practical strategies, covering 2 parts: timing entry and exit points, and stock selection tips. First, let's discuss how to identify buying opportunities. From 1957 to 1959, Gerald Loeb's fund doubled the returns of its competitors. At that time, O'Neill was new to the industry and learning from masters. In 1960, after studying the fund's records, he found that all 100 stocks bought over the past year were purchased after hitting new highs. If a stock fluctuated between $40 and $50 for months, Gerald Loeb would buy it quickly at $50 to $51 after it broke new highs. This greatly inspired O'Neill, so he developed his own buying rules. First, buy quickly when a stock breaks out of consolidation and is setting or about to set new highs. Second, daily volume should increase by at least 50% above average. Buying at new highs is crucial. It's the best entry point, especially after consolidation followed by a breakout, often signaling huge potential profits. After entry, the only task while holding is finding good exit points. Wall Street legends believe in exiting while profits are good, like jumping off an elevator while it's rising, not waiting for it to fall. O'Neill identified 5 signs of a bull market top, all good times to sell. First, when a stock shows its largest single-day gain and closes much higher than any previous day during the uptrend, consider selling. Second is the appearance of the highest single-day trading volume after the uptrend phase. Third is The emergence of an exhaustion gap on the chart. How do you identify it? O'Neill gives an example. After a prolonged rise, if a stock closes at $50 high one day, opens at 52 next morning, and maintains uptrend, that $2 gap is an exhaustion gap. Fourth, the final frenzy before peaking means rapid gains for 2 to 3 straight weeks on weekly charts, or 7 to 8 strong up days in 8 to 10 days on daily charts. Sell immediately then. Fifth signals major distribution. Huge volume after long rise but stagnant price. That's when smart investors sell. O'Neill also shares 2 practical stock picking tips in the book: the follow on effect and relative stock theory. Let's first discuss the follow on effect. Typically, when one industry achieves major progress, related industries gain follow on benefits. For example, in late 1960s, aviation stocks surged due to jet aircraft innovation. Years later, boosted by aviation growth, the hotel industry flourished. They continuously expanded branches to meet growing tourist demand. Thus, hotel stocks also experienced strong rallies. Similarly, in late 1970s, rising oil prices not only boosted oil stocks, but during 1979's surge, oil service stocks providing equipment and services also skyrocketed en masse. In mid-1990s, as internet industry soared, demand for network speed or bandwidth became bottomless. So fiber optic specialists also got a big share of this internet feast. So when picking stocks, you can also follow this model. Infer another potential hot industry related to the current booming one. Next up, let's discuss the relative stock theory. When an industry performs exceptionally well, a supplier or relative company benefits. For instance, when Boeing sells mini jet planes, each one includes chemical restrooms made by Monogram Company. With profits skyrocketing, Monogram's stock price surged tenfold. In 1983, Fleetwood Enterprises was a Super Bowl stock, leading in the recreational vehicle sector. Back then, it had a small relative, Dexco Company, whose stock also shone brightly. So what does this company do? It supplies vinyl-coated panels and hollow core doors for RVs and mobile homes. So whenever you spot an outstanding company, research it deeply to find these relative ties and uncover great investment chances. Of course, everything has 2 sides. When an industry booms, it's like one success lifts all around. But if that industry hits trouble, the first to suffer are the related industries or companies that gained earlier. For example, from 1980 to 1981, the oil industry peaked, then crashed. Oil stock declines dragged down the entire oil service sector, causing a chain reaction plunge. All right, that wraps up the main content of Laughing at the Stock Market for you. Published over 30 years ago, it's helped thousands of ordinary investors catch big winners. The 4th edition includes many real stories like this. O'Neill encourages investors in the book, if you've been hurt by bear markets, don't get discouraged and quit. Many bull stocks await you. He also quotes General Colin Powell, former U.S. Secretary of State. Success has no secrets. It demands preparation, hard work, and learning from history. Okay, that's our take on Laughing at the Stock Market. Book notes are below the audio. Catch you tomorrow.